Welcome to TheoTrade. This is Don Kaufman. It's July 25th, 2025. Just 10 minutes to go to the cash close here on this Friday afternoon. The S&Ps, they might be up some 25 handles, but they are doing absolutely nothing, But when it comes to the S&Ps, not everybody is totally tuned in to what volume looks like, but just allow me for a moment to display what I mean by absolutely nothing. Look, I get it. Markets are grinding a little bit higher, but check this out. Under the volume, we're doing 600 and basically 25,000 contracts. What is it, like Christmas Eve? Let me actually show you how crazy that really is. I mean, that number is astounding. You're like, high? No, low. Really low with 10 minutes to go to the close. And how low can volume go? Well, let me show you where we are right now. I'm just going to put my mouse crosshairs on it. You know what? Forget it. Let's just highlight it. Let's get crazy. So here we go. Let's highlight it. Is there any other day in recent history? And the answer to that is yes, right here. That's why I was like, what is it? Was it Christmas Eve, which is a half a trading session? That's actually how low some of the volume happens to be today. There was also a half a trading session. Just recently, there was a half a trading session the day before July 4th, July 3rd, which is, again, it's a half a trading session. That's the kind of volume we're doing over there. So, you can try to read into this all you want. There's not that much to read into, but I am going to show you some really interesting things here, of course, on this TheoTrade weekend update. It's what I call cashing in on crap, because there are sectors that they truly deserve your attention right now. And the reason is because all that's left right now is literally we're buying crap. And I want to show you exactly that where the leadership is coming from. Now, the easiest way to present this to you, I'm going to show you the easiest way to present this to you. If you look at the SPX, we're going to the SPX. We're going to the big boy, the SPX. So the SPX has actually had a pretty good week. I mean, net, we are ever so slightly outside the upper edge of the expected move. So for the most part, what that implies, okay, is that, from a S&P standpoint, we're strong. Obviously, there's a rally. I mean, really nothing happened on Monday. Nothing happened Tuesday. Wednesday, we burst to the upside. Absolutely nothing Thursday. And here we are on Friday, just kind of trickling to the upside. Nevertheless, so we're outside the upper edge of the expected move. And the expected move this week was right around $75. So it's kind of outperforming. Then we're going to cruise over. We're going to switch it up for a second. We're going to cruise over to the QQQ, because the NASDAQ, you're like, that's really what matters. The NASDAQ's been driving the marketplace. Yes, but the NASDAQ right now, take a look at its expected move, all right? And again, week over week, this crap is important, because what are you looking at right now? You're looking at, it's about halfway home to the upper edge of the expected move. So what do you got? You got absolutely nothing out of the NASDAQ. But then you have to pause for a second and go, well, then what's moving the marketplace? Exactly. That's the exact point I'm trying to make. Crap is moving the marketplace. And right now, no one seems to, they're not really fazed by it. But, we're not seeing heavy sell side activity in like NVIDIA. When it comes to it, like NVIDIA, where is it on the week? Massively unchanged. If you take a look at Tesla, okay, I know Tesla had earnings, but it hits lower edge of the expected move. Take a look at Meta this week. What's Meta doing? Nothing, okay? Listlessly higher. Okay, Google, all right, Google had earnings. You got me there, but it had earnings, and it actually broke to the upside over here. Taking a look at Amazon, I mean, this is what matters. Amazon actually had a decent week. That's not exactly crap, right? Apple, okay, listlessly higher. Again, but the driving forces in here, Microsoft, which has been, hitting upper edges of the expected move, it's basically unchanged in the week. I can't stress enough. It's not, okay, this week is not exactly what you thought it was. By the way, with just moments to go, check this out. Check it out. This is why I talk so extensively about expected moves. We're getting sucked into what? Well, the expected move is basically 63.72. Okay, we're taking a shot at it. 4 minutes. We're not going to make it all the way down here, but this is I mean, this is basically not really a breach of the expected move. We're just driving right back down to it. So let's talk, okay, for just a moment. When I say we're officially buying crap, okay, let's get down to it. When I say let's get down to it, let's actually go all the way down to the bottom of the screen over here. What I actually have is sector ETFs, right? And I want to start with stuff like XLK. For those of you that have absolutely no idea what XLK happens to be, this is technology. It's real similar to the QQQ. You realize the technology sector is massively unchanged. Again, this has been one of the primary drivers, if not the primary driver of the marketplace. And that's important. Okay, that's unchanged. If you look at SMH, which is actually the semiconductors, you want to know something interesting? The semiconductors actually took a hit. Why did they take a hit? Intel. I'm going to give it to you straight. It's Intel. Okay, Intel actually had earnings. Turns out Intel sucks. Tried for the corner and missed. Okay, just a bit outside. Then let's get a little bit. Let's get crazy. Looking at XHB, home builders. So why am I bringing up home builders? Just to make the point. XHB. Okay, who all of a sudden decided that this is the greatest thing ever, right? Again, I'm showing you this because I actually think it's a little bit cause for concern. You're down to this point where you're starting to talk about meme stocks again, and all of a sudden we're buying crap. So the home builders, okay, with interest rates where they are, then you start looking at XLY. XLY actually is not great performance. XLY is actually heavily into Amazon and Tesla, but here's XLI. A lot of people don't know this one. It's industrials. Okay, what are the industrials doing this week? Upper edge of the expected move. Wait, we got more fun. If you haven't looked at utilities, okay, smashed the expected move last week. Okay, this week smashed the expected move. They did have a pullback, but all of a sudden, you got to look at this chart in utilities. How wild is that? All of a sudden, we're buying utilities. We went through SMH. Here's actually one of my favorite. Do you realize, okay, one of the primary sectors that's a driving force this week, healthcare? Who would have thought? Okay, when I say that we're buying crap, I told you we're buying crap over here. You would think with like RFK, it's getting killed. There was a lot of things getting handed down this week, exploded to the upside, outside the expected move, spectacular move. Then we come into XLP. XLP has been stuck in the middle with you. XLB, which is a materials sector. Nobody's even heard of the materials sector. Nobody ever wanted to hear about the materials sector, but it is the upper edge of the expected move. XRT, which is just retail. Okay, so this is retail, upper edge of the expected move. As I said, and I'm going to finish again with XLK, which is none other than what? Okay, remember, this is technology, massively unchanged. Better keep an eye on this stuff because I wanted to take you a trip into exactly that, just to show you what has been driving the marketplace is no longer driving the marketplace. The Magnificent Seven is more like, again, maybe a Fab Four at best. But a lot of them have earnings next week, and I'm not going to dispute. There's some big earnings next week. That are going to shape the market a little bit more. Maybe technology actually comes back, maybe it doesn't, okay, but it just hasn't been a driving factor this week. Moreover, okay, there's just no volume out there. And as I said, we're coming into the cash close here, and the S&Ps, they pulled back, they bounced a little bit, we've laughed, we've cried. We're just basically hop, skip, and a jump above the expected move. Nevertheless, though, that volume, okay, look at this. We're in the next 48 seconds, we might hit 700,000 contracts, which is like the volume is basically 30% below what it effectively has been. Kind of cool. Yes, I know all that crap off the top of my head because, well, look at this all day, every day. So we're officially buying crap, and you should know exactly that because at some point you look at the marketplace and you're like, wait a second, okay, what's actually driving this thing? Now, last week I was actually talking about equal weight. Okay, equal weight versus S&P market cap. And this was RSP. And I want to bring this up because last week I brought something to the table where I'm like, it's a bit of a concern. Equal weight S&P, which basically means that every stock in the S&P, okay, is, in effect, okay, it's over, people. Every single stock is equally weighted. Look at this huge breach of expected move. So what it means is that if everything was equally weighted in the S&Ps, it had a huge move to the upside, okay? But the reality is the S&Ps themselves didn't make that kind of a strategic move. The S&Ps barely, they gripped the upside of their expected move. So I'm actually going to show you something really interesting on this point because again, this was last weekend's update. I was talking extensively about this. So we brought up RSP and we went over here to studies, right? And we went to add study, and then we go down to compare with, and we actually cruised up to custom symbol. And what did I put in for a custom symbol? I put in, okay, SPY. So I'm going to type in spiders, and it's a comparison chart. And then I'm actually going to switch them a style, okay, from a candle chart over to a line chart, lines and lines, and that's a comparison chart. Okay, so we're equal weight, okay, versus market cap weighted. Then I'm going to cruise over here to the little, okay, beaker. It's not a beaker, it's an Erlenmeyer flask. Get that right. We're actually going to come over here and put correlation. Double click on that. We're going to correlate RSP, okay, to the SPX. Hit apply, hit OK. I'm going to explain all of it. Just everybody calm down. I'm going to hit the little sprocket up here. I'm actually going to go to equities. I'm going to go show volume subgraph, turn that off, hit apply, hit OK. And then I'm going to show you, last week I talked extensively about right here. There was a critical correlation breakdown, right? Look how quickly that actually repaired itself. The marketplace, okay, didn't though break apart, but I'm telling you, these, okay, there are signs of cracks all over the place in the market. I'm not getting you all bared up with no place to go. You don't need to get all bared up. You're looking at some of the tech stocks, they're not performing. But all of a sudden, okay, what you did see is you saw, okay, the equal weight play catch up to the S&Ps. And the correlation went from like breaking down, like we're like 30% correlated all the way this week to 92% correlation. Okay, I'm telling you, okay, these are signs and rumblings of volatility already in play. And the reason I brought this to you last week, I had no idea that this was actually going to bounce back. Okay, now it's truly, it's all hands on deck. Okay, as I stated last weekend, I'm going to state again, you're on the clock right now. So we're cashing in on crap, we're buying crap. Okay, we're seeing like this correlation breakdown all of a sudden really snap back. But the correlation snap back, that's bad for technology. It's a very bad sign that the correlation came back. This isn't a good sign. This is a bad sign, right? And people are like, no, correlation came back. It's a good sign. No. I don't think you understand. It basically means, okay, that technology has completely stalled. And again, you're on the clock right now. When I say that you're on the clock, it just basically means, hey, look, there's going to be rumblings of volatility hitting this marketplace. To continue over here, let's cruise over for a moment. We're going to switch gears entirely. We're going to go to the bond market. And I want to bring up the bond market because next week, okay, you're going to hear from, ladies and gentlemen, the Fed. Oh, it couldn't have happened to a, it's a better person over there. By the way, I fully enjoyed watching the president with, of course, Jerome Powell. Anybody else out there amused by that one? It did it for me. It really did. So on July 30th, okay, we will actually hear, and that's Wednesday of next week, we will hear from none other than Jerome Powell. And we won't hear him plead his case about expenses, but we're going to hear him plead his case about interest rates. Right now, we're looking at about a 97% chance. Yeah, I'll just show it to you. It's about a 97% chance, okay, of no cut. However, what's going to be interesting about this Fed meeting, and the reason I'm bringing up the bonds, and I'm even commenting, because I got to tell you, most of the Fed meetings, yada, 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 okay, they didn't do anything. And, I yada yada over the best part, which is they didn't do anything. The truth is there could be dissenting votes. I think that there's a couple of people that are, sitting in the voters' chairs at the Fed presidents. And there might be some dissension in the ranks. What that basically implies is like, several of the Fed vote, several of them, there's voting members, there's non-voting members, but several of them, maybe one or two, may actually buck the trend and say, no, we should cut. Of course, they're going to do that. Why? Okay, because they're all trying to get in to be the next Fed chairperson, which that actually could be announced, in weeks, months. It's still really early, but the next Fed chairperson doesn't actually, take hold until, into pretty much the second quarter of next year of 26. But it is what it is. And if there is dissension in the ranks, bonds may freak out. The bonds may freak out. And again, my interpretation of the bonds freaking out, anything in the 111 handle. So stay tuned on that particular front. Speaking of the bonds, it's kind of ironic. The bond volume wasn't bad. The bond volume wasn't bad. It was the S&Ps. The volume absolutely sucked. Okay, I mean, just that's for what it's worth. The S&P volume sucked. Look at that. We got over 700,000 contracts. Okay, who did a big trade at the end of the day? Somebody did. Anyway, so the Fed could create some bond risk. Remember, the 111 handle is important. Now, I do want to give you guys a quick update on skew because skew is flying high. Look, I haven't seen the skew obviously today, but I think it's going to continue to increase. Just here's the bottom line. If you opened up like the whole history of skew, where we are in skew right now, and I'm actually going to make this very distinguished, decisive line. Here we go. You ready? Because you can count on one hand the number of times the skew has been all the way, basically 159 and change. Let's just round it to 160 and not tell anybody. So the skew's all the way up at 160, which is insane. Okay, what it implies is that people are buying out of the money puts and they're financing it by selling out of the money calls, right? Which is very, very natural. They're hedging going on. But at the same time, when you look at other volatility indicators, when you look at like VVIX, this is the volatility index, it's dead. It's lying dead on the floor. Like you could put a chalk outline around it. If you look at VIX, okay, what is the VIX? Okay, the VIX is dead. This is the lowest instance of the VIX in a very long time. All right, so this is the lowest instance of the VIX since, you really got to come back here to basically when the inauguration happened, period. And I got to tell you something. To me, like the VIX shouldn't even be this low. And by the way, I'm not alone in that thinking. I just want to show you something very interesting. If you look at the volatility futures, just 26 days out, the volatility futures are already pricing, okay, forward VIX at 1790. So 26 days from now, like the VIX, you're like, no, the VIX right now is at 15. And I go, no, it's really at 1790. You go, where are you getting that number from? That's what the volatility futures say. 54 days out, it's basically at 20. So it's actually one of the biggest contangos that we've seen pretty much in modern history. Okay, that's a massive, massive contango. And what contango is, it just says like spot VIX, okay, is insanely low, like day to day, like there's nothing going on. But the future, the future is bright and filled with risk. That's what it says. Like I'm not like, interpretive dance over here. Basically what we're saying is crap is going on today, tomorrow, maybe even next week. But holy crap, we're going to be in the throes of volatility into August, September. Look at this all the way out into October. It's like 21 vol. What the hell does that marketplace see? I'll tell you exactly what they see. They see a Trump administration, and they're not used to it. So that's my skew and volatility update. To say that skew is high doesn't mean like the market's going to tank. Doesn't mean that, but it surely doesn't help. It just means a lot of people are starting to actually get some hedges going on. So it is going on. All right, to continue the update. One of the things that has been spectacular, okay, thus far, between last week and this week, I am batting 50% in earnings flips. By the way, for those of you that have no idea what an earnings flip is, okay, we are actually placing specific butterfly trades on earnings announcements. If you hit 1 out of 3, you're wildly profitable. Because I'm going out there and I'm risking like 50 cents and making $1.50, $2, okay? And I hit this week. I did 6 trades this week and I hit 3 out of the 6. Tesla, 176% return. Google, 135% return. Okay. Newmont Mining, 206% return. It's a winner, winner, chicken dinner. I like it. By the way, I absolutely love earnings flips. And the trades are on for, less than 24 hours. I put them on, 3 o'clock in an afternoon, 3 o'clock Eastern time. Take them off, the next morning right after the cash open, and they've gone spectacularly. Earnings flips are doing extremely well. Again, we're batting 50% right now between last week and this week, and that's just the earnings season kicking off. And of course, things are going to get even more interesting coming into this next week. Last, but definitely not least, we go back to the SPX. We start with the SPX, we end with the SPX because it's about the SPX. So the SPX, all right, this is technically a breach of the expected move. It is, okay? But, I mean, we breached by what? We were supposed to be at 72. We ended up 87. I mean, holy crap, it's like a rounding error. But I'll give it to you. It's a breach. If it's more than 10 points, I count it. Okay. If it's more than 10 points of a breach, I count it. Here we have about 15, 16 points of a breach. What's important though, okay, isn't that, what happened last week? It's what's moving forward. So next week we have a Fed announcement. Next week we're going to hear some big boy earnings announcements. And guess what? The expected move, it's going to reflect it, not by much, but it's going to reflect it. So the expected move, okay, which goes out to August 1st. August 1st is next Friday, is going to jump right around 90 bucks. It's not set in stone yet. I pick up the expected move. The official expected move comes in 4 minutes. But obviously, this is pretty accurate. It's going to be $90. So we just came off of a week with a $75 expected move. So we're going to expand into what? About a $90 expected move. All right. What do you feel about that? Well, I'm going to tell you what you feel. Get ready to rumble. Get ready to rumble. I mean, there's going to be a little bit more movement in this next week of trade. Obviously, we're looking at individual implied volatilities. Here, this is actually, I love doing this because if you look at July 28th, there's a 6% in volatility. That just basically means it's a snooze fest. The same thing is true of Tuesday, but things start to really pick up on Wednesday for the Fed announcement, Thursday, and obviously in the end of the week. Some of that is earnings. Some of it is Fed-induced volatility. Nevertheless, things are going to get more interesting. Okay, remember what I said, all right? In any given marketplace, I'll kind of wrap with this. In any given marketplace, you look for signs, okay? I mean, there's a lot of signs over here, and you can sit here and start to prognosticate about being overbought, looking at all the charts over there. But again, I don't think that necessarily does anybody any justice. I don't think it does any good. What I'm actually looking at is when we start buying sectors, okay, that no one's wanted to touch. Like I've been looking for a reason, like why are we buying utilities? You're like, because utilities and electricity, look, if you're going to talk about electricity, they're going to buy like nuclear stuff, right? So you're not going to get, Oklo. You're not going to get me on that one. Why are we actually out there buying home builders? Because the housing market, what, does it suck? You think they're going to lower interest rates? It's not going to make any difference. Even if they do lower interest rates, what are we going to get? 2 cuts this year? Okay. Oh no, we can take the short term rates all the way back to 2%. And if you're going to influence the 10-year, the 10-year is still going to be 4.5%. So you don't got me on that one. Okay. We look at like the industrials, well, industrialization of America is picking up. Okay. Yeah, great. Well, we've known that, for a while, but why are we buying that? Because there's nothing left to buy because the valuations are completely and totally insane. And now people are starting to pay attention. That's the answer that I've come up with. You can come up with any answer you want. So that compounded with, this S&P equal weight versus market cap, they're both displaying the exact same thing. And what's that? Okay. Well, people are done with buying like the same names again and again. And right now they've actually shifted to crap. We'll see if that actually lasts. But as I said to you, I believe that we're actually on the clock. Get ready for some more volatility. Everybody recognizes there's an August, 1st deadline for tariffs and so forth, yada, yada, yada. I've heard it all before. We've also heard about, taco, Trump always, chickens out. But at this point in time, okay, I don't think those are the issues. I think the issues are, okay, we've been buying. We haven't looked back, and we're in a dangerous place right now. Very dangerous place, both for volatility and the S&Ps. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.